Welcome, everybody, to our long verticals and diagonals webcast. I'm Connie Hill, Senior Manager and Coach here at Schwab. Happy to see you join me here today. You know, last month, the SEC made an approval for several stocks to receive some additional expiration dates. Well, people who like to sell premium are really excited about that. And we're going to get into why they might be excited about having all these extra potential premiums to sell amongst the Magnificent Seven, as well as Broadcom. There's a couple of ETFs they did that too as well. So we're going to get into the details of that here today. I am joined in the chat by Ben Watson, good friend and fellow coach. You guys, if you've been going out to the live events, you guys know Ben really well. In any case, he's here to help me out in the chat. Now, if you have questions, go ahead, chat those in, okay? I will keep my eye on the chat, and Ben will have my back to maybe catch some things I can't quite get to. And so we do want to hear from you, so please let us know when you do have those questions. Those of you listening on the recording, when you have questions, go ahead and put your questions in the comments section on YouTube, because I go back and review those throughout the day and make sure you get your questions answered as well. Let's go through some disclosures and lay out our agenda for today. Options carry a high level of risk and are not suitable for all investors. What we talk about here today is for information and educational purposes. Don't consider a recommendation. We'll be using the Paper Money software application. This is what you download to your computer. It's the most robust version of Thinkorswim with lots of nice tools on it. Investing involves risk, including the loss of principal. When we talk about probabilities, keep in mind they are theoretical in nature and never guaranteed. Past performance of any security or strategy does not guarantee future results or success. And one thing to note that is a little bit different with the Paper Money application and a live account is in the Paper Money, it will not assign an option early. The live market can get you early on that assignment. So that's one difference we try to make you aware of. If we have any example trades, I'll try to bring those to your attention so we can talk about them. All right, now I'm seeing lots of familiar names. Happy that you're here. And looks like we have some new folks joining us here as well. We welcome you. If you want to say hello, let us know who you are. Feel free to put a comment in the chat, and you can call yourself a newbie or whatever you want. But in any case, we're happy to have you. Now, typically, we'll go through any announcements that we might have, talk a little bit about the construction of long verticals and diagonals, although our focus today is really going to be on the diagonal. We'll mix those up sometimes, but today that's where our focus is going to be. We always are talking about what's the impact of the option greens, right? Time, price, volatility, those three big factors. We're going to discuss those as we look at our trades here today. And we're always going to do some example trades, and we're going to follow up on a couple of previous trades. Now, with a diagonal, for maybe some of you who are not as aware what a diagonal trade is, well, with spread trading, we have long legs and short legs, right? And it's no different with a diagonal. We have a long leg and a short leg, short option. However, what the difference is with diagonals is yes, we're going to use different strike prices, but we're also going to use expiration cycles, okay? And that's where it comes in, this idea of these options being more available, or more options expirations available on some of these stocks. Kind of gets you thinking, hey, what could we do about that with these that have more frequent expiration cycles? All right. Now, these trades can be structured either bullish or bearish, just depending on what your outlook is and how aggressive you want to be with it. Now, those of you that maybe are familiar with the covered call strategy, right? You own the stock and you sell a call against it. Well, you could just kind of extend that idea for a long call diagonal, where you are typically, instead of buying the stock, you buy a longer dated option, and then you sell premium against it. And one of the big focuses there is sell premium, reduce the net debit. Sell more premium, reduce the net debit, okay? It's called a poor man's covered call. You may have heard it referred to as that. And so there's a lot of ways that we can structure a long leg, a short leg, different expiration dates to work to our advantage. And so we're going to do just kind of a little tweaking on that idea here today. All right. Stagel says diagonals. I don't quite understand. You do a lot of verticals. No problem. we're happy that you're here today. You're going to learn. Hopefully your comfort level by the end of our session here today will be a little bit better with diagonals. Now, to start out with, I want to review a couple of trades, and then we're going to get into some example trades and look at these expiration dates that premium sellers are so excited about. So let's hop on over to my Thinkorswim. Now, if you were with me last week, we did a long call vertical and a long put vertical on Reddit for their earnings. Now, I'm going to kind of zoom into so you can kind of see what the construction of the trade was here. So we had a 160, 170 long call vertical, and we had a 150, 140 long put vertical. And these were based on the market maker move, where the market had priced in a certain type of move that they expected the stock to move. Well, in this scenario, after they announced their earnings, I believe the earnings was announced at night, and so then the next morning it started to trade. Well, initially it gapped up. In fact, it gapped up clear up here in the range where we wanted it to be with our 160, 170 long call vertical. All right. But what happened? Man, it quickly faded. Look how much this faded. The range that day was $27.38. So from the high price to the low price, that was the range. So it was a really big swing. And so it ended up, unfortunately, we got stopped out on both of those. Okay. If we had held on to, say, the long put vertical, perhaps it would be in a better position, well, at the end of the day, or even trading to the end of the day yesterday, as well as we're getting some follow through here today. But that can happen sometimes with earnings announcements, where initially the market gives one indication, like this back gap up, and then the momentum just falls. It just goes away. And that's exactly what happened on Reddit. Now I'm going to take you to another stock here. I'm just going to give you a quick glimpse at the stock. And this is a long diagonal that I've been working with in our paper money account, okay, as an example trade. Now I'm going to come over here. You kind of see what the charts look like, generally speaking, a little bit more bullish. And we entered into the trade on the 22nd of January. So this thing's been working for a little bit of time. I'm going to come over here to the monitor tab. And here's my trade right here. I've got it in this section called long dated diagonals. And this particular one, we entered in, we did a diagonal with it. We bought a put, a June 26 put. We did this in January, so we bought a lot of time on this particular one. If we come over here to the account statement, I'm going to show you what it looked like when we got into the trade initially. We sold the January 30, 78 put, and we bought that longer dated June option at a 72.50. It cost us $460, but because we sold the 78 put, that brought our net debit down considerably here, down to 258. Well, what if we can extend this trade a little further and a little further and sell another put, and then sell another put, and sell another put? That sounds interesting, doesn't it? One thing with, depending on what kind of account you're trading in, sometimes there's margin that's tied up when you're doing a short put. But by having that protection leg out in the future, it really helps out how much cash you have to commit to the position. So as we come over here and look at what it's doing here, we still have that long leg, but it's time to sell more premium against it. Yep, we collected on that initial, but it's time to sell some more. So what we're going to do, we're going to go to the trade tab here. And one thing that's nice here is it does have monthly, any option that has options usually has monthly expiration, but it's got these weeklies. And those do provide more opportunity for you to sell. Now, in the case of what we're going to do here today, we are going to work with the February 20 options because these ones just expire tomorrow. There's not a lot of premium left in those to sell. As we open up the weeklies here, we are going to end up selling here. Let's see if this still looks good. I was looking at maybe selling the 74, but I think what we're going to have to do is maybe back off that a little bit. Sometimes people like maybe a low 30-something delta or a high 20-something delta. And so in this case, let's go with the 73 here. Now this one, it's liquid. It's not, the spread on this stock has become a little bit wider than it was initially when we got into that trade, which is not as desirable, I will admit. Okay, but we're going to go ahead because we have a lot of puts so we can sell against it, a quick expiration date. I'm going to draw your attention to this theta column over here. Here's my delta column. And sometimes we'll reference that as far as, what strike price do we want to work with? And then the theta, what does this tell us? This tells us about daily time decay, right? Usually the further out an option is, the lower the time decay is. The closer it gets to options expiration, the bigger the theta becomes, and that daily time decay, it is more rapid. Really, it starts to drop off the closer we get to options expiration date. All right, so we're going to go ahead. We're going to sell the 73 here. We're going to hope for a midpoint price. So we'll just go ahead and select that. That's going to give us the natural. Let's move it over there. See if we can get maybe in the neighborhood. See if we can get $1 out of it. We'll go this way. And let's go ahead. We're going to sell this. And we're going to put it in that bucket of those long dated diagonals. All right. So we saw our net debit on the trade was down to $258. So now if we sell another $100 against it or $1 against it and bring that premium in, at that moment, then our net debit is reduced to $1.58 on that long put. That's just kind of there for some protection. All right, I'm going to send this in and then I'm going to see the questions that you have in mind. Oh, somebody wants Noodle Brains wants to know what happened with our Morgan Stanley trade. We've still got it going. It's time to sell some premium against that. That is from a different class, I believe. Is it from a different class? Yeah, it is, because in our dynamic diagonals along verticals, we don't have anything yet. So that actually isn't a class I teach Monday, I believe. So no, we're not going to follow up on that today. Don't have the Akamai diagonal. We probably did a follow-up on it previously. Dora is one. Well, actually, let's go to CB first. Is it too late to start a position in IBKR and join your trade? Anytime we do some example trades, we encourage you to do them in your paper money account. That is the way that we learn things, is by practice, practice, practice. So those of you that are like, not so comfortable with this diagonal strategy, and we're going to put a little twist on it here today. Yeah, practicing out in your paper account is a great thing to do. Now, is there still time? Well, there is still time. This price of the long dated option would be a little bit different now. It'd be $560. So maybe you might decide to use a different long strike on it. But in this case, the selling of the option, we're hoping for lots of opportunities to sell put after put after put. That's what our focus is going to be on that trade. In what basis do you make these entries and make changes? Dora, great question. We didn't even really talk too much about the trend of the stock, but the idea with this one, in a traditional diagonal, long call diagonal, like a covered call, we would buy the long call, sell the short call against it. In this case, our main driver in the trade is a little different. That's why I say it has a little twist on it, because our main driver in this trade is we want to sell put. We want to sell put premium. And it's rich right now. It's juicy right now, especially on some of these stocks. And so the idea here is, okay, our main motivator is sell put after put after put, but buy that longer dated protection, a little bit out of the money, so it doesn't really take, there's a cost to it, but hopefully we can reduce that net cost with all the premiums we sell against it. So I hope that will make sense to you here. And in terms of changes, Dora, In an ideal world, this is what would happen with this trade. In an ideal world, it would, we can see it in here now. We've got 8 days on this. Okay, tomorrow's Friday. Then Monday is the 16th of February, which is President's Day. Are the markets open? No, they're not open. So we've got Saturday, Sunday, Monday of time decay going on, where that theta is really working to the advantage of the premium seller. And so in an ideal world, and this is what happened with the first put we sold against it, it expired worthless. In our case, we're going to look at it and we're going to see next week if it's in a position to expire worthless, or if we want to roll it meaning close it out, buy it back for whatever it might be worth, and then sell another option. That can be based on technical analysis. In our case, we're going to basically use the calendar, meaning how many days are left to expiration, and is it a good time to maybe roll it, not try to get every single penny out of it, but maybe get the biggest chunk out of it and do it again. Appreciate you asking me these questions. Yes. So somebody said, this is, what did you say here about a sandwich here? I missed what you were saying about a sandwich. No, we won't talk about any other stocks. I shouldn't say that. I can't entertain any questions that you might have as far as, hey, would you do it on this stock? Would you do it on that stock? We are going to focus on some Mag 7 stocks here. Okay. All right. Next up, credit sandwich spread. That's what FibZone said. Is this like a credit spread sandwich? If that's what you want to call it, but it is just the idea that we're trying to sell some premium. So who are the stocks that got these expiration dates? I'm going to do this and try to put them in here alphabetically. Apple. We'll look at Apple here. And what does Apple have? Well, it has all these. It had some weeklies, but now it also has what? It has February 18th, which is next Wednesday. Now, if the market had been open on the 16th on Monday, it would have had a Monday option here as well to choose from. But because the market's closed, they just skipped and went to the next one, which is Wednesday, which is going to be the 6th. And then we have our regular Friday expiration that was already in place, right? Because Apple had those weekly Friday expirations. Well, now the 11th, well, this has 11 days. The 23rd will be the following Monday. Okay, and then you can see, oh, Monday, Wednesday, Friday. Now, as time passes and another week of time is expired, they will roll out another Monday, Wednesday, Friday date. Well, to an option seller, that gives you some flexibility. You can be a little bit aggressive with it. You could be a little bit more conservative with it, but just the fact that we could maybe do some options that expire on a Monday and a Wednesday entertains a whole bunch of possibilities to us that maybe weren't available previous to them rolling out these options. So we've got Apple. I'll tell you, Apple, Amazon, Google with the L, not Google without the L, Meta, Microsoft, NVIDIA, and Tesla. Now, those are the Mag 7. They also introduced them to Avgo, which is Broadcom stock, and then a couple of ETFs, they did it too as well. We won't get into the ETFs here today. Let's do this. Let's take a look at the first one. We're going to take a look at NVIDIA. Biggest large cap stock that we have out there right now. Now, I would say this particular stock has been more sideways. I mean, yeah, more recently it has had a short-term bullish little run here, but man, it can't get past that 193-ish area. It's having a hard time doing that. Earnings are coming up. Sometimes this is a concern to people. In this strategy, we're not going to worry about the earnings too much with the exception that we're going to still plan to hold over earnings because of the nature of what we're dealing with here. Okay. So we are, in the case of NVIDIA, we're going to sell a shorter dated option and we're going to buy a longer dated option. Okay. I'm going to start out with the longer dated option because there's less to talk about there. We're just going to go out to April. If we wanted, could we do any of these weeklies or the March monthly? Absolutely, we could. But because the idea here is buy a longer dated option, use that as our hedge leg, and then see how much premium we can sell up in these time frames. And that's kind of the ideal, what we're looking for in this strategy. So we're going to go to the April 17th. You can see these oodles of open interest out here, isn't there? Man, thousands of contracts. That sure makes you feel good as a trader when you see, I must have hit my finger on that too hard, to see such liquidity in the options. That gives us a narrower bid-ask spread, right? 12 by 12.15, 12.10. Yeah, we know there's lots of trading activity, and these are the types of stocks we want to be working with. So on this, I was looking for us to sell. Let's see if the 185 still looks good. That's what I had gone with here initially, 185. But typically we might want to do like a 30-something delta, right? Have a high probability of expiring out of the money. Obviously never guaranteed. This column here shows us the probability of it expiring out of the money, and it's actually a long time away. And I'm going to point out Theta decay is not tremendous at this point, right, on this longer dated option. So we're going to go with, let's do the 175 here. We're going to adjust a little bit. Actually, let's do 170. What I'm saying is, which one is maybe closest to a 25, a 26, 27-ish delta? Okay, so that it's a little out of the money. So let's go with this 170. This is the one we're going to buy. So I'm just going to click it, get it brought up in our queue here. Then we're going to look at the shorter dated ones. Now, we could do next Wednesday, the 18th. We could do February 20th. We could do the 23rd. We're actually going to pick on this one. We're going to do the one that expires the 18th, which is Wednesday. Hey, how cool is that? We haven't sold on a Wednesday expiration before, but we're going to right now. And then in an ideal world, maybe this would expire worthless for us a week from today, or we do something with it a little bit early and roll it. And the roll might occur in this class. Not guaranteed, because if I see a better opportunity before the class takes place, I'm going to do that, but we might end up waiting till our class time. All right, so what are we going to sell? We're going to look for maybe a 25-ish or 20 delta. And we're kind of falling between the two of those here, 25 delta, 18 delta. We'll go ahead and use this 182.50, but I want to point out to you here, notice the theta here. 28, 29, 26, 24. Yeah, is this a nicer delta as far as time decay on the option? Absolutely. And again, we have tomorrow, and then we have the day off on Saturday, the day off on Sunday, the day off on Monday, decay, decay, decay. And theta represents your daily calendar time decay. Some people wonder, does that include the weekends? Yep, it includes the weekends and the holidays. It absolutely does. All right, so we're going to go ahead and sell the 182.50. Now I'm going to hold down my control key so that it'll put that and match it up with that longer dated in April. Now let me check here real quick and see what kind of questions are coming up that we haven't answered. Ben, thank you so much for helping me out. You're getting lots of questions. You know, the Mag 7 are those big cap stocks that have just been lifting the markets as they've been bullish. And, you know, last year, some of them didn't perform actually quite as well as others, right? Nonetheless, they're still considered the Mag 7. Maybe there'll be a new grouping to be created at some other point. Noodle Brains, it's confusing. It's too rushed. You know, this is more of an advanced strategy class, and maybe I should have told you that at the beginning, that we have some strategy classes that are for, say, short verticals and long verticals, and I'm going to agree they're a lot easier to learn. This one is an advanced class, so I am going to stretch you a little bit here. I'm going to stretch your mind. If you're not quite ready for it, that's okay. Stick around, see what you can learn, okay? Even though you're like, I don't know, babe, I've really dabbled in diagonals much or know that much about them, okay? Now, the question is here, what is the exit strategy going to be here? What is the plan? Well, the plan is hopefully that we collect a great majority of this premium. Right now, I mean, look how tight that is. 175 by 177, 3 pennies, 2 pennies, we can handle that. And what it does is it makes it more feasible for you to be up in a trade because you're not having to make up a big amount that the market maker gave you, right? Because there's so much liquidity out here. I mean, these options, think about it, maybe even 5 weeks ago did not even exist. And look how many open interest contracts there are out here on the put side and the call side. Okay, so the plan here is we're selling out of the money. We're hoping to collect all of that premium. If the plan is it could maybe expire worthless, but more likely than not, we'll probably roll it. We'll see how much we've been able to capture of the ultimate that we get in here, right? Whether it's 184 or whatever. And then, you know, say we're down to 20 cents or so. Awesome. That would be lovely if that happened to us in this trade. And then what are we going to do? We are likely going to buy it back, close that trade, and then what would we do? Well, we'd go out to one of these others. If we want to go out to Wednesday again, let's see, the 23rd is Monday, but the 27th is a, let's see, what day is the 27th of February? Looking at my calendar here, that's a Friday. So we've got a Wednesday, a Friday here, and of course the holiday, so we don't have anything on the 16th. Okay, so that is going to be the strategy here. Now, as we look at it, you might look at it and go, I don't know if NVIDIA has a bullish entry. We saw it was right up at support, but the plan is buying that longer dated option for protection and then selling the premium. So we're going to go ahead. We're going to put this in, and we're going to put it in our bucket I've named Dynamic Diagonals and Long Verticals class. Somebody wanted me to give it a dynamic name, so we did. All right. We're just going to do one contract here, okay? And we're just going to kind of keep track of it in one contract increments. The math is a lot easier to take care of. Now, one thing I'm going to mention to you, let's go ahead and get this sent in, is when you roll an option, it doesn't keep track out on your profit and loss the premium that you already collected from, say, the first option. So, say going back to our IBKR, we saw the first one that we sold. We saw what that premium was, but it doesn't enter in, and it actually expired worthless, okay? But we don't see it calculated in here anywhere. So the other thing with this is you've got to maybe do a spreadsheet or write it down on a piece of paper, what that initial credit was. And then you kind of have to track them manually to make sure you really are paying the net debit of that longer dated option and then just collecting premium after that. Okay, so I do want to point that out to you. Let's see. Oh man, never lazy. I appreciate that compliment. I'm happy that that is the case. Dave says, no, the Morgan Stanley was part of this class. Okay. How to make multiple accounts in paper trading. I think what you're talking about is maybe the grouping. In paper money, you have 2 accounts. You have a margin account and an IRA account, and that's all you get. But you can create groupings like this longer dated diagonals grouping if you want. Suppose I wanted to send, I'm not going to, but suppose I wanted to send this trade that we're working on to a different category, straddles and strangles, which it really doesn't fit there, okay? So you wanted to send it there. We could say If you put the trade in together, it'll keep it together. These were entered into separately, so you have to do them separately. But then you could just say move to group. And if you just wanted to create a new group, click on add group and give it a name, and then it'll move the option there. In fact, I've done a mini video on this, how to create groups on your platform. I'll show you in a little bit where you can find that video. Let's see. What is the reason? Thea says, what is the reason to consider the example trade of NVIDIA, even though it's above its 10 DMA? Technicals are not going to be used as extensively here in this particular strategy as so much the idea that we want to sell premium and how we can accomplish selling the premium while at the same time having a hedge in there. If we just wanted to sell it naked, we could, but that really wouldn't fit the dynamic of this class because of how valuable it can be to just have that longer dated option out there. Are we planning to be in this leg of the trade that long? We're not, right? We're expecting to be out of it next week, hopefully collecting a little bit of time decay here. All right, let's see what other questions we have here. Yeah, Ben's letting us, reminding us we'll be able to see the profit and loss in your account statement area, just like I could with our, that's a different trade here, IBKR, I'll put back up here. Just like we could see it here. And now we see the additional premium that was just, that we just put that trade in for, we collected that additional premium. So you'll still be able to track it here. I just want you to know it's not going to be reflected on the activity and positions page because it only reflects current positions. It's not a position we have anymore. So therefore, it's not reflected. Okay. How do you calculate the risk in this trade? It's a little tricky, quite honestly. It's a little tricky because of the different expiration dates. Now, a long vertical, short verticals, using the same expiration date, and so it's easy to determine what our max loss really is, what our max loss and max gain can be. One way that we can maybe take a look at this is, let's go ahead and open up the one we just did here. Let's pull up an NVIDIA. And we're going to put in an expiration date that's appropriate. So we're going to pick the longer dated option. Okay, that means we're going to go out to June. And we're going to put, it was June 19th, we're going to pick June 20th as that date. And then typically we'll want to put this to reflect current date, which that was yesterday. So here's today. I just want to go up a day. And then here, this says hide positions, but we want to actually, in this case, we want to show the position. And so we're going to see both the long leg and the short leg here. And let's see here. Something's missing. Let me do a set slices to the break even here. Usually you'll get a graph here. You'll get a risk profile graph. Just trying to make it show what we currently have in there. I'm not certain why it's not graphing it for us, but that can be a way to determine what your max loss theoretically is, although it's kind of, I'm going to say, a little bit more difficult to pin down. Ideally, would love for this, I mean, if this thing just went sideways on us, we don't care. We might like that. If it went sideways on us again, we don't care because we're collecting the premium. And if it, say it breaks through the resistance and pops up, that will enhance those shorter legs to decay a little bit more rapidly. All right. Yeah, it's essentially what the risk in the trade is, essentially. So we're hoping to reduce the net risk every time we sell some premium, right? So here's 690, but we sold 190 against it already, so that's why we have our $5 net debit. How many legs might we typically use? You would want a position size if your position sizing is, say, $1,000 per trade, say like on this one. We could possibly have done 2 contracts here. For simplicity, I think it's just easier to do it with 1 contract to show you how it can work. Okay. So usually there's 1 long leg, 1 short leg. This is a trade that is balanced that way. Typically, you're not going to see extra calls sold against it because that would make it a different trade. All right. How many of you have become subscribers to our Trader Talks channel? I sure hope you have. If you haven't, go ahead, click down that little button, bottom right part of your screen that shows you, it says subscribe on it. You click on it and that subscribes you. When you do that, it just makes our content easier to find. You can see our playlist for the class. You can see what's coming up today. Next up is going to be Cameron May investing in dividend stocks. I wanted to show you, somebody said, how can we create those extra accounts? And really what they are groupings. I'm going to show you where my video is that shows you how to do that. It's in this little section here called bite-sized content. I'm just going to say play all. It's going to bring up a big old playlist. We put a couple new videos out here every week from our group. And you might have heard Barb's voice bleed through there. All right, I'm going to scroll down here. And I've got one how to, mine are based on Thinkorswim. And, oh, where did it go? Where did it go? Okay, let me look up here by my face. These are the watch list ones, candlestick patterns, how to create your own custom toolbar in your window. Man, I can't find it right now. Custom order template. I've done a lot of these, so I can't remember actually the order that I did them in. In any case, there's one there that'll show you how to do the groupings. Okay, it's embedded with another concept there as well. Okay, all right, let's do another example. Would that be helpful if we could go through another example? I think it would be. Yeah. Let's see here. Another Mag 7 name, Tesla. TSLA. Now, I'd say Tesla's kind of been a little bit on the sideways as well. I mean, it did hit another high, another 52-week high here earlier in December, at the end of December, it did that. Then had this big pullback and maybe just a little bit of a pull here, a little bit of a run. So we're going to do the same thing. We just know there's a lot of premium out there. We want to try to sell it. And we want to have a hedge leg to cover ourselves so we don't have to tie up margin or even not be able to do the trade because we don't have enough cash in our account. We had to, for example, have 100 shares of Tesla stock put to us. It's an expensive stock, yes, we know that, but it ties up a lot of capital, right? If you needed to have 100 shares put to you, $42,000 for just one trade is quite a bit of capital. So we're not going to buy the stock. We're going to buy a hedge leg just in case things don't go quite the way we wanted them to. Okay, but let's come over here. We're going to hit the trade tab, and we've got the same thing, same dates that we just saw on NVIDIA, right? We see the Monday, Wednesday, Fridays, these newer dates that have come out. Now we're going to do the same thing. We're going to come out. We're going to buy an April option here. We're going to go a little ways out of the money. You can see Tesla is really widely traded here as well. These are the April options. They've been around for a little bit, so it's nice that they do have some open interest on it. Could we use the March weeklies? We could. We could use the March monthly as well. I want to go back just a little bit so we have multiple opportunities to sell premium. Okay. This one, let's see if this strike still looks pretty good. I'm looking at, it's clear up here now. 375 is looking for like a 25-ish delta. Okay. 385 it was earlier, but let's go with 375 right now. I'm going to click on the ask price here to get that queued up in our order. And then we're going to do another short dated. And again, we could pick which one we want. We're going to go with Wednesday because we've never sold a Tesla Wednesday option. But just that idea kind of fits in nicely where our class is, and the ability to maybe either roll it right before class or in the class is why I'm picking it. However, if somebody wanted to be more aggressive, if we had options, let's see, when is this next one? The 20th. Let's see, 20th is going to be next Friday. But if somebody wanted to be more aggressive, the holiday kind of fouls us up a little bit. If there had been some for Monday, we could have gone for Monday, and that would have been considered a little bit more aggressive. This one, we're going to do the Wednesday, and I explained why, just kind of timing wise, but you could easily go for the ones that expire on the Friday or the Monday or the next week out. But we're hoping to do this multiple times, and I want you to pay attention here when we open up these February options. Look at where these theta values are. Okay, 62 cents a day, 60 cents a day, 58 cents a day. You know, it's really high up there as far as the daily time decay. And as an option premium seller, we love that. We love to see those giant thetas. Okay, this one's a little bit bigger than what we were seeing on NVIDIA. So here, let's go ahead. We're going to do the, on February 18th, I was looking initially at the 25 delta here, which put us, the 25 is going to put us a little bit different than I had pegged earlier. We were going to go what 405 we're going to do here instead, 402.50. We're going to bring in $4 of premium to help offset this long put of protection that costs us $12.75. That's a decent chunk, isn't it? What's the probability that it would expire out of the money? It's high. Here's our probability of expiring column. And we can see right there, right now, about a 73% chance of expiring out of the money. Now remember, it's theoretical in nature. It's never guaranteed, but it gives us an idea. Is it a higher probability or a lower probability? And we're seeking a higher probability and balancing it with and bringing in some premium. If you wanted to go further out of money, you certainly could, right? If you're like, man, I want to sell a 15 delta, go for it. There's plenty there. Okay, I'm not showing all of them right now, just so our screen kind of stays intact a little bit better. All right, so we're going to sell. I'm going to hold down my control key on the bid price of $395. And here, we're going to see if it'll give us our midpoint, which is about $873. That's our net debit after selling that premium. And then what's our strategy going to be? Our strategy is going to be see if it can expire worthless or get it down to chump change, go buy back, you know, if it's a small value. And a small value might sometimes be $1, right? If we had to buy it back for $1 and we had a net of $3, that's still a pretty decent premium to bring in for a short-term trade. Okay. Some people might have rules where they say, I want to make sure that I buy it when I get 50% of that. If you want to put that in your trade, you absolutely could. We're not going to do that here today because our intent is to see how much we can milk out of it and roll it by our next class. Okay, so that's that trade. Again, we're just going to do one contract, a little bit easier to understand. And again, if you're trying to understand this strategy, and I'm putting a twist on it, it is an advanced class, you can do it in your paper money account. And what's nice is you can follow it along, you can track it, you can see what the questions are that you have, and then come to class and we can talk about what those questions are, or you can put a comment in YouTube and ask me about that. And people do that all the time. So we're going to put it in our dynamic diagonals vertical calls trade bucket, and we just got filled on it. All right, my time is almost up here. So I'd like to issue you a couple of invitations. One, Ben and I would love to have you follow us on X. It's free. We post educational content out there. And even some fun stuff on the weekends, you'll see that we'll put out there, but more educational content. Things we're noticed about charts and stocks and what's going on, something in the news that might be impactful, we'll let you know about it. So it's free, it's easy, just follow us along, even if that's not your social platform of choice. I encourage again, if you can subscribe and you haven't yet, man, it makes it easier to find our videos, not only our webcast, but those other short videos that I showed you. And, if this was helpful to you today, hit the like button on the way out. You can do a stranger a favor by letting them know you found value in the content. I did not see a survey out here today, so you're off the hook with the survey. If there was one, Ben will post it again in the chat. I haven't seen that reposted. All right, you guys, take a little bit of a break. I know this is a little bit more advanced material, a little bit thicker meat to chew, but I'm happy that you joined me here for our webcast. Coming up next, as we saw on the calendar, Cameron May is doing investing in dividend stocks. He'll be right at the top of the hour. We'll see you there. Bye-bye.